What is going on, guys? It is Ahmed, and I am back today to discuss something that has been talked about quite a bit lately. I think it's been all over the media, all over YouTube, and that is penny stocks. So, a lot of the time, I feel like, especially in the YouTube space, a lot of YouTubers have been talking about penny stocks, and, including myself, and how, again, it's been such a big focus, but it comes with so much risks that people don't understand. So I want to kind of take a deeper dive on, how we should be investing in these penny stocks, how to be more responsible with the money that we put into these things. Because again, I respect the money that you have gained in the stock market, and I do respect your wealth and your finances. So because of that, we have to understand that penny stocks do come with quite a bit of risks, but there's a way to mitigate that, to kind of have fun with them, because again, it is enjoyable seeing large percentage gains. But when we see those days that we have large percentage losses, we have to understand that kind of comes with that game of penny stocks. So I created a little presentation, again, 5 slides, because again, a lot of people did appreciate the presentations from previous videos. So I do want to just kind of touch base with everyone. So I'll make myself a little small here, and we'll go ahead and get started. So to start, I do want to talk about the most important things to consider before buying penny stocks. And I think this is just standard across all stocks, but mainly penny stocks for sure. So why are you investing in the penny stock? So that's something we have to consider. Jim Cramer, one of the most admirable and very well respected and known stock traders, currently, again, he's on CNBC Mad Money. He tells traders in his book, Real Money, never to purchase a stock unless they have an exhaustive knowledge of how the company makes money. What do they manufacture? What kind of services they offer? So what did it bring to the table? That is the first question you have to ask yourself before you put your money somewhere. Because again, you want to make sure your money grows in the future, right? So your family, your children, your children's children can have money that, again, wouldn't be there otherwise if you weren't investing it into good places. Also, understanding volatility. I think this is very important when it comes to penny stock, guys. So again, volatility, just by definition, if you Google this, you can find the same definition. It is a statistical measure of dispersion of returns for a given security, a stock, or market index. In most cases, the higher the volatility, the riskier the security. I think most of you have a very good understanding of that. So, except for things like Tesla, which are anomalies, the majority of stocks, once it's a well-established company, we see that very modest return over year. So again, when we look at things like index funds, like the S&P 500 index fund, we typically see about a 7, 8, 9, 10% gain per year, which again, for those of us who have been very focused on penny stocks, we see that in a matter of seconds, sometimes minutes. So let's again understand volatility to a little better extent, because again, that makes us sometimes sell at a big loss or buy at an extreme high point, and then we see the stock kind of tumble thereafter. A big thing that I feel like people have not been discussing well in the YouTube space and in general, I haven't really been reading much about it in articles, is the direct public offerings. Again, by definition, it is a financial tool that enables a company to sell a stock directly to its investors, right? Without using an underwriter as an intermediary. So no middleman, no broker, no firm, nothing like that. It just goes company directly to shareholders, selling their stocks directly to investors who are interested in the company. And we see volatility with these kind of things that happen because people start getting scared. Because again, it kind of makes sense. Once a company liquidates its shares for additional revenue, people see it as, oh, they just want more money for their pockets, which isn't true. Although we do see direct offerings more often than not when a stock runs up. Correct? So that does hold true, but for well-established companies, that need cash flow, direct offerings make total sense. So we saw this with BNGO and NDM, and I'll touch base on what we see usually with price action with direct offerings. Because for me, when I see a direct offering, this is not financial advice, nor am I doing this nor am I a financial advisor, But when it comes to direct offerings, when I see them, that's when I consider getting into a stock if I haven't gotten already. So direct offerings usually are good buying opportunities because we see a dip for those weak hands that think, oh, this is when a company is going to crash. Because oftentimes with penny stocks, low market cap stocks, we do see the liquidation of shares over and over, bring the value of the stock lower and lower to sometimes to the point of no return, unfortunately. But for well-established companies that we believe in, that doesn't happen. Lastly, the price to earnings ratio. We hear this all the time, PE ratio, and I didn't put it here, so 1623. But you can calculate the PE ratio by dividing a company's market value per share by its earnings per share. So for Tesla, usually we want this number under 10. For Tesla, they have a 1600 PE ratio. Guys, that is astronomical. If you see that number and you're just looking through, different stocks to potentially buy into, if you see anything this high, anything over maybe even 20, 30, 40, if there's nothing that rationalizes that, you need to run, look the other way and run. Run fast, because that is an overvalued stock. With Tesla though, we know they're a disruptor. We know things, that number actually makes more sense for this company, even though it's still pretty insane. It's more sensible when it comes to a company that's well established, that again, might still have a very strong potential in the near future, like Tesla. So guys, I bring this presentation to you all because again, I feel like a lot of people have been asking me, what should I do? What should I do? I want to put my whole portfolio in penny stocks. That's not smart. For me, I always look at, about 80% of my portfolio is very well established, stronger, bigger growth stocks. Again, the Teslas, the Microsofts, the ones that have that guarantee modest return over time. But again, better than keeping my money in a bank, for example. But when it comes to penny stocks, they're fun because again, for me, I'm more aggressive with having about 15 to 20% of my portfolio in penny stocks because we do see substantial gains with them in the short period of time. But we have to understand, guys, if you don't believe in a company, but you're buying into it because of the hype around it, please, please, please don't make the mistake of holding on too long and losing all the gains that you have made on it. Because I know people who have doubled, tripled, quadrupled their money, and they decide, I want to keep holding. I kind of want to see it grow more. I want to see it grow more. They wait till the next day, and then it completely crashes, and they regret it, and then they come crying. So guys, I don't want you to be one of those that goes through a loss, because then you won't appreciate the market, you won't appreciate stocks, and you'll develop a pretty bad relationship with the stock market. So please, please, please do your due diligence before buying into penny stocks, because understand they come with an extreme risk. But for me, when I buy in, it's like, for example, Zomedica, I've been talking about it quite a bit. For me, when it comes to these kind of stocks, I'm buying in as an early adopter because I see a pretty strong potential future for them. BNGO with the Sapphire, strong potential future. SENS, strong potential future with the 90-day continuous glucose monitoring system. All these different companies with pretty strong futuristic appeal, kind of what make me buy into them instead of just going into general stocks, which I do have a pretty significant amount of in my portfolio. So next, what I kind of want to talk about is direct offerings and what we kind of see with price action with those kind of things. So let's see here. If we go to NNDM, the most infamous, because it's been going through a lot of public offerings for the last, I don't know how long time. But basically, we see a stock run up. The company thinks that the price of the stock has definitely it's considered overvalued for the time being. They have a direct public offering. We see it come crashing back down. Same thing, up and down, up and down. But it's volatile, but in the upward trajectory for companies that are strong, for companies that have a future. And in DM, we know ARK Invest has invested into it, and they have one of the strongest ETFs out there. So again, it makes sense that they keep buying in when these dips happen. And for other investors like myself, I see it as a buying opportunity for sure. BNGO, what happened today? Guys, the company's doing fantastic. I heard about this back when it was around $1. I bought it in just because I was like, this seems like it's going to be a great company. But what happened? Again, public offering, the price of the stock completely plummeted in the aftermarket because the weak hands ran out and said, oh, this is when they're going to start liquidating their shares. The company value is going down. I don't believe in it, etc., etc. But again, for strong companies, buying opportunities occur at the point of direct offerings. So guys, thank you so much for tuning in. And again, I appreciate every single one of you. You have been showing me so much support, and it's just been really overwhelming. So thank you all. And until next time, everybody, keep investing.